A lot of people are talking about an upcoming bear market, and who knows when the stock market is going to decline for a period, for example, of 6 months. Because from the period of 1926 to 2017, there has been a lot of bear markets going from 20% declines to 80% declines. That's why in this video, I wanted to share with you which strategy you could use when there is an upcoming bear market and what you can do for your own portfolio so you can still generate positive returns even though the whole stock market is going down. But before diving into this video, if you like this type of videos and you like to see more videos like this one, please consider subscribing to my channel. It's free, it helps me a lot, you can't imagine. Even though the stock market is actually rising on an average of 8% on an annual basis, it doesn't mean that the stock market isn't going down. As I said, from 1926 to 2017, there has been 6 bear markets going from 20% to 80% declines. And when you are in a buy and hold approach, a bear market can only mean losing money on your portfolio, and you don't really have a way to generate positive return when the market is going down. And worse than this, the stock market can absolutely stagnate during a long period of time. If you had bought, for example, the SPY, the S&P 500 ETF in 2000, you would have made zero money between 2000 and 2012, where the stock market experienced several declines, whether because of the dot-com crash or the financial crisis. In 2012, you would exactly be at the same point than when you had bought the SPY in the year 2000. And even though myself, I'm a long-term investor and I truly believe that holding a portfolio of dividend stocks is really the best thing you can do for yourself, because on the long term, it's going to increase in value and it's going to pay you interest under the form of dividends, there are definitely better ways that you can take advantage of bear markets. Which leads me to talk about a strategy that is called the covered call. A covered call aims to take advantage of a potential short-term down move on a stock that you're currently owning. Let me explain. Let's imagine that you have 100 shares of a stock and you think that this stock is going to decline on the short term. Instead of just waiting and seeing if the stock is actually going to decline, you could do what we call a covered call and so take advantage of that potential short-term down move while you still owning shares for the long term. And we call that covered because you have a long position because of the 100 shares that you own, and then at the same time you sell a call so you have a bearish outlook, or at least on the short term. And it's a strategy that is very often used, and it's a great strategy if you have shares of a stock and you'd like to benefit from, for example, a bear market. And you essentially have 3 considerations when you're trying to do a covered call. First of all, you need to choose the stock, then you need to choose the expiration, and then finally you need to choose the strike. And we're going to go one by one so it's completely clear, so don't worry. So the first consideration is which stock should you choose so as to try the covered call strategy. The first thing that you should think about is try to choose a stock that is volatile but not too volatile, and let me explain. If you choose a stock that is very volatile, as you're selling calls, you want the stock to decline on at least on the short term. And if the stock is too volatile, you're going to have more probabilities of seeing your call expiring in the money. And if the call expires in the money, then you need to sell 100 shares of the stock. But luckily for you, you have those 100 shares. But ideally, try to go for stocks that are yes volatile, so you have a good premium when you sell your call, but not too volatile. And let me give you an example so it's clear. If you decide, for example, to use the covered call strategy on a stock like Nikola, it's going to be quite hard for you and you're going to have a lot of stress because of the volatility of the stock itself. You can see how volatile the stock is, and in my opinion, it's not at all a great candidate for the covered call strategy. Compared to a stock like Johnson & Johnson, where there is a bit of volatility offering good premiums when you're going to sell calls, but it's not a huge volatility like on Nikola. Hence why I said that you need to choose volatile stocks, but not too volatile. And why not going, for example, for ETFs like XLE, XLF, XLK, where ETFs are composed of several stocks all together, meaning that you're going to experience less volatility than if you were using the covered call strategy on the stock, and if you use it on an ETF, you're going to experience less volatility and still you'll be able to collect quite good premiums. A second factor to take into account when trying to choose a stock for the covered call strategy is trying to choose a stock that you'd like to own. As you need to buy 100 shares of the stock and then selling calls against those 100 shares, why not choosing a stock that you wouldn't mind owning really on the long term, so at least on the long term you have a bullish view, even though on the short term you have a bearish view. It's much easier and it's much more manageable to choose a covered call strategy on stocks that you don't mind owning, so at least the 100 shares that you have, you're genuinely happy to have those 100 shares because you believe in the company, you believe in their financials. Rather than going for a stock that you absolutely don't believe in, is going to cause you a lot of stress for nothing. Because the thing is, if you go for a stock that you absolutely don't believe in, you think that the stock will go bankrupt, and the stock actually goes to zero, then you'll have lost your whole investment because you'll have bought 100 shares of that stock. Hence why it's way better to at least go for a stock that you believe in on the long term and that you think is going to rise, but on the short term you believe that there is going to be a down move, whether because of a bear market or because of bad news. At least you'll be able to take advantage of that short-term down move while still believing in the stock on the long term. For example, if you have 100 shares of an airline company and because of the COVID crisis, for example, you think that the stock is going to go down, then it makes a way better candidate for the covered call strategy because on the short term you have a bearish view, so you're going to sell calls and make money that way, even though on the long term you think that this airline company is still a very solid company, they're still going to get better once the world reopens. That's why in this type of examples, the covered call strategy might be a great fit for this type of stock. By the way, if you have a small account and you don't have a lot of capital to buy a lot of stocks, I've got a great news for you. If you go into the description of the video and you click on the first link, you'll be invited to open an account with Webull. And if you deposit $100 at Webull, then you'll be given 4 free stocks completely free for you, valued up to $1,600 each. So don't hesitate to go into the first link of the description, open an account and deposit $100. Now that we saw the first consideration, which meaning that you have a short-term bearish view on that stock, but you still believe in that stock on the long term, now let's talk about the second consideration for the covered call strategy, which is the expiration. Personally, I have a preference for selling covered calls that are going to expire on the Friday, meaning that if we are on the Monday, I like to sell calls that are going to expire on Friday so I can collect that weekly premium and do that over and over. That's personally something that I really like, and I'd rather do this and sell calls on a weekly basis and collect that premium on a weekly basis rather than selling a call that is going to expire in 5 months. After that, know that there is really a lot of value in the time to expiration, meaning that if you go for a call that is going to expire in 5 months, then you'll collect a much bigger profit and you'll make a lot more money than if you were selling a call in 1 week. After that, you need to understand that is it better maybe to sell weekly calls, and then when you do the sum, is it going to be more profitable for you than rather like selling a call that is going to expire in 1 month. You need to make the calculation to see if it's a good return on investment for you, but personally, on top of the return on investment, I'm comfortable selling calls on a weekly basis. For example, if you see that selling a call that expires in the next week is going to bring you $100 profit, but selling a call that is going to expire in 1 month is only going to bring you $300 profit, then it's better maybe to sell weekly calls where it's going to bring you $100 each, so at the end of the month you make $400 rather than selling one call that is going to expire in 1 month and only make $300. That's in this type of thinking that you should probably think, and maybe that is going to help you choose your call and your expiration, so it's maybe more profitable for you. But then once you have chosen that expiration, for example, you've decided to go for weekly expirations, meaning that you're going to sell calls that expire on the next Friday, then comes the third consideration, which is which strike should you choose. And as you're an option seller, when you sell a call, you want your call to expire worthless, so it goes to zero, and so you keep the full premium. So the further out the money you go when you sell a call, the more probability of profit you have at expiration. However, there is no free lunch. The further out the money you go, the less the money that you're going to earn when you write. And the closer to the in the money strikes you go when you sell a call, the more money you're going to earn when you sell a call. That's always this type of balance. And that's very logic when you think about it. If someone is absolutely sure of making a profit, they're not going to earn a lot of money. Compared to when you have less probability of making money, you're going to earn more when you win. That's completely normal. And personally, I like to choose strikes that have a delta of 30. And why? Well, because delta can be roughly associated to the probability of expiring in the money. Choosing a strike with a delta of 30 allows you to have a probability of expiring in the money of 30%, and so a probability of expiring out of the money of 70%, meaning that when you sell a call that has a delta of 30, then you have 70% chance of making a profit, and you have 30% chance of seeing your call expiring in the money. And I think that in general, that's pretty good balance between the probability of profit and the premium that you're getting when you sell that call. Hence why I like to choose strikes with delta of 30s. But after that, nothing prevents you from going further at the money, increasing your probability of profit. Or if you want to earn more money when you win, nothing prevents you to go closer to the at the money strikes, so you earn more money when you win, but you have less probability of profit. That's always this balance, as I said. Now that we really saw the different considerations in terms of stocks, expiration, strike that I personally like to choose and how you can do it for yourself, let's take an example on Delta Airlines so it's completely clear for you. So here I've chosen Delta Airlines and I've chosen the February 5th expiration, which is going to expire in 7 days. So as I said, I choose a weekly expiration because I personally like to have weekly expiration so I can go quicker in my process of selling covered calls. And as you can see, I have now without the option chain in front of me. And you can see that I have the delta on that column. And if I go for the 30 delta, for example, on the call side, then I'm going to have to go for the 42 strike. And if I click on the 42 strike and I decide to sell that call, then I'm going to collect a profit of 66 cents, meaning I'm going to make $66 if the call expires worthless, which is pretty good in my opinion. And you can see my pop, which is probability of profit, is about 78%. You see that if you go the further out the money you go, meaning that I decide to move my strike to further out the money, you'll see that my probability of profit has increased, but now I earn less money when I'm right, meaning that if I win that trade, I'm only going to earn $14, but I will be right 95% of the time. And if I decide to go to the closest out the money strike, to the 41 strike, then I'm going to earn $98, but I only have 72% probability of profit. So you see that it's not that bad actually, and it really depends on you on which type of balance do you want to have. As I said, personally, I like to go for the 30 delta strike. I think it's a good balance overall. I hope you enjoyed this video about the covered call strategy. What are the different things that you need to look at in terms of stock, expiration, strikes, and it really made sense overall. If you have any question, please don't hesitate to put it in the comment section. I'll be happy to answer any questions that you have. As I said, if you liked this video and you found it interesting or helpful, please consider subscribing to my channel so you can receive future updates about my future videos. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.